Hi, this is Steve Gorin with my quarterly webinar here. Thank you everybody for attending today's webinar, which is planning for business exits from C corporations, intrafamily business transactions, and other developments. Before we begin, we want to cover a few housekeeping items. At the bottom of your screen are multiple application widgets you can use. All the widgets are resizable and movable, so feel free to move them around to get the most out of your desktop space. You can expand your slide area or maximize it to full screen by clicking on the arrows in the top right corner. If you have any questions during the webcast, you can submit them through the Q&A widget. We will try to answer these during the webcast, but if a fuller answer is needed or we run out of time, it will be answered later via email. Please know that we do capture all questions. A copy of today's slide deck is available in the resource list. We encourage you to download any resources or links you may find useful, and there's also a link there to my fourth quarter 2018 newsletter, which is the technical support for everything I'll be saying today. For the best viewing experience, we recommend using a wired internet connection and closing any programs or browser sessions running in the background that could cause issues. Webinars are bandwidth intensive, so closing any unnecessary browser tabs will help conserve your bandwidth. This webcast is being streamed through your computer, so there is no dialed-in number. For the best audio quality, please make sure your computer speakers or headset are turned on and the volume is up so you can hear me. Some networks cause slides to advance more slowly than others. If your slides are behind, pushing F5 on your keyboard will refresh the page. You can find additional answers to some common technical questions located in the Help widget at the bottom of your screen. You know, I'm glad I majored in economics because we keep talking about widgets. An on-demand version of the webcast will be available approximately 30 minutes after the webcast and can be accessed during the same audience link that was sent to you earlier. This webinar is accredited for 1.5 hours general CLE credit in California and Illinois and 1.8 hours general CLE credit in Missouri. That's because we're more generous in Missouri than we are the other states. And we value your opinions and appreciate your participation in the course. For your convenience, we have created we don't have polling questions. Here we go. We've got. You actually will see some code words there that you'll have to be entering. Okay, so going on to the next slide. So there was our welcome, and then here comes our overview. So even though the webinar started talking about planning for business exits from C Corps first, that's the longest part of the webinar. I'm going to go through the shortest part first, annual charitable contributions for businesses after 2017 tax reform. And then we will get into talking about the sale of C corporation stock and its code section 1202 exclusion, which is wonderful, but also is kind of overblown in some ways. And we'll spend the bulk of our time on that and also talk about how you can, again, try to move your entity to make it the most tax efficient, income tax efficient thing you can. And then we're also going to talk about a 2018 tax court case that addresses intrafamily business transactions. So on to the next slide, slide 4. So 2017 tax reform put in a $10,000 limit for the sum of one's state income tax, non-business real estate tax, and non-business personal property tax. And so a lot of the states, or some of the states, started putting together ways around using these tax, ways around this deduction by using tax credits. So for example, New York instituted a 70% tax credit if you would simply donate to certain government-funded programs. And so this 70% tax credit, the idea for it is you get 100% charitable contribution, and then you're saving 70 cents on the dollar on your state income taxes, so you have something that's fully deductible, and it's going to be zero out of pocket to you because the 100% charitable contribution is going to save you taxes in excess of 30 cents. So the idea is you'd have your 70-cent tax credit and your tax savings in excess of 30 cents, so you would have a tax benefit of over $1 for every dollar that you contributed. So the IRS didn't like that one iota and responded with a notice and then followed that up with some proposed regulations. And basically what the notice said is that that's a quid pro quo. If you're going to get a state tax credit in exchange for your donation, well, you're getting a real economic benefit in return. And actually, I do believe that the government, from a technical viewpoint, is totally correct about that. You are getting something back. Now, in the past, it didn't really bother the government that you were getting something back. They did in several private letter rulings say, you get your tax credit, but we're going to ignore that because when you get your state tax credit, you are foregoing a state income tax deduction. So we're not going to mess around with your charitable contribution deduction because that state tax credit reduces another deduction. So, for example, if you gave $1,000 to charity and got a 50% credit, so you got a $500 state income tax credit, then you would get a $1,000 charitable contribution deduction, and we're not going to reduce it because you have a $500 state tax credit that's going to prevent you from having a $500 state income tax deduction. Because otherwise you would have paid that $500 with cash and gotten a state income tax deduction for it. So you're foregoing the state income tax deduction when you pay your state income taxes using this credit. So either way, you're $1,000 out of pocket. Either way, you're getting a $1,000 deduction. We think that's fair was the logic, and so we're not going to worry about reducing your charitable contribution deduction. Well, along comes 2017 tax reform and says, hey, you're not going to get a state income tax deduction because you're limited to $10,000 for the sum of all those items, the state income tax, non-business real estate tax, and non-business personal property tax. And, for example, somebody in New York City who own their own home, they're going to be paying real estate tax more than $10,000 a year, so they're not getting any state income tax deduction for all practical purposes. So the idea is that there is a quid pro quo, and it's not like we're going to reduce your state income tax deduction because you weren't getting one anyway. So the IRS said, all right, whatever kind of state tax credit you're going to be getting, we're going to call that a quid pro quo, and we're going to reduce your charitable deduction by that. And they also put in a de minimis there. So if the state tax credit was only 15% or less, then you don't have to do the quid pro quo. You get the full tax credit, the full charitable deduction, as well as getting the benefit from the state tax credit. So 15% or less state tax credit, you get the full charitable deduction. More than 15% state tax credit, and your charitable deduction gets reduced by that state tax credit. So I did have a question to informally ask the IRS in a public setting. And if, say, we went back to this example of a $1,000 donation and a $500 state tax credit. So what they're going to do is they're going to ding our charitable income tax deduction. So now we only have a $500 charitable income tax deduction because we're going to subtract off the benefit of the $500 tax credit. So the regulations address only that the charitable reduction is being reduced. The charitable deduction is being reduced. What they don't mention is that $1,000 payment got you that $500 charitable deduction, but it should also give you a $500 state income tax payment for federal income tax purposes. So let's suppose that you're a taxpayer who maybe you rent your apartment and you have modest state income taxes, so you would get the full benefit of that credit. Or you get the full benefit of the state income tax deduction. Sorry about that. So that $500 credit should also translate into a $500 state income tax deduction. So really what they should do when they take the $1,000 tax credit donation, they should call it a $500 charitable payment and a $500 state income tax payment, and then see whether you get the deduction. You may or may not get a charitable deduction based on your charitable limitations. You may or may not get a state income tax deduction based on those limitations, but at least the federal income tax system should recognize that. So I asked them about this, and they said, oh, we didn't really think about the state income tax deduction. We have gotten other comments on it, so we're going to take those into consideration. So my guess is that when they finalize this regulation, they will say that if you make a $1,000 payment and have a $500 state tax credit, you'll get a $500 charitable deduction, which again may or may not be deductible, and a $500 state income tax payment, which again may or may not be deductible. So that's for individuals. So now all these business owners had questions. Well, how do all these rules affect me? So go on to slide 5. And the IRS had a press release that said that if you deducted charitable contributions as a business expense, we're not going to worry about these rules. So there's actually a set of rules that talks about if you pay charity, you may actually have a business reason for that payment. So for example, suppose a restaurant says, on Tuesday nights, we're gonna donate 10% of any bill to charity. So you'll have that charity's night out, and that charity publicizes it and says, hey, all you donors, go and eat out, and when you eat out, 10% of your bill is going to go to charity, and so you should go out and patronize this restaurant or these sets of restaurants. And so when the restaurants go and they get their payment for their food they sold that night, they have to pay the 10% to charity. That is a business expense. So it's not a charitable contribution because it was a promotional thing. The charity got sales in exchange for promising to make payments to the charity. So if you look in my materials, so you can see at the top 2G4D1, that refers to these limitations, and then there's a cross-reference over to the business income tax area. So going to slide 6, so the IRS issued a revenue procedure that talks about, well, what happens if there's a state tax credit donation? And that revenue procedure split it up between a C Corp versus an individual. Because we know that under the 2017 tax reform, C Corps are the favored entity for income tax purposes. So the notice said that if a C Corp makes a payment to charity and expects to receive a tax credit that reduces a state or local tax, then the C Corp may deduct under Code Section 162 as a trade or business expense. That's what 162 is our trade or business expense. May get a deduction for the amount of the tax credit. So, for example, if the C Corp is going to receive an 80% tax credit, it will deduct 80% of that donation without needing to prove a business purpose. Then the remaining 20%, it needs to prove business purpose. So that's a very nice benefit for C Corps, is it relieving them from having to prove business purpose if they make a tax credit donation. And that's because C Corps are allowed to deduct state and local income tax. That limitation of $10,000 does not apply to C Corps. It only applies to individuals who are paying income tax directly or through their pass-through entities. Income. So that's slide 6. Slide 7 says, well, if you're an S corporation or a partnership, then we will give you the similar benefit of getting that tax credit under certain circumstances. So if you make a tax credit donation and you get an 80% tax credit, then you will be able to deduct 80% automatically, and 20% you have to prove as a business expense if you meet these conditions. So what are the conditions to deduct this 80% without having to prove business expense? So first of all, you have to be operating a Code Section 162 trader business. And then the next thing, here's the really big, the next two things. So first of all, the credit has to be for a state or local tax that's incurred on carrying on the trader business. So, and it has to be imposed directly on the entity. So let's suppose you have an S Corp or a partnership or an LLC tax as a partnership. That entity has to pay that tax. And it has to pay that tax because of its business activities. And the third bullet point, here's the kicker, that state or local tax cannot be an income tax. So if that entity is paying, like that S Corp or partnership is paying real estate tax, that's a good tax. So if you get a tax credit against your real estate tax, then we're going to give you the benefit of this trader business expense for the tax credit amount. If it's an income tax, we're not going to, because again, state and local income tax, those things are evil, they're limited, so we are not going to give you the benefit if it's a state or local income tax. The other thing, note that I put at the top, S corporation or partnership, but not a disregarded entity. So if you have a single member LLC and it makes a tax credit donation, forget it. That single member LLC, that's owned by the individual, for example, and that individual just has to apply the rules without the benefit of this revenue procedure. Now, of course, if you had a single member LLC that's owned by an S Corp or partnership, well, then that would be treated as made by the S Corp or partnership. So the bottom line is that if it's a disregarded entity owned by an individual, you don't get the benefit of this procedure. But if you're an S Corp or partnership, directly or indirectly, then you can get the benefit of this. Again, it's going to be for real property tax and not state or local income tax. Okay, so the next slide, our keyword is credit. So write that down for the purposes of submitting your CLE. All right, on to slide 8. Here is the main event, sale of C corporation stock. So a lot of people have made a big deal about this. If you have C Corp stock and the sun and the star and the moons align, you can get an exclusion from the capital gain tax. You don't have to pay any federal capital gain tax on that sale, or at least to the extent that it's allowed, and we'll go through that in a moment. So we're going to talk about this exclusion, very briefly mention other opportunities when dispose of C corporation stock, and then we'll get into the income tax dynamics for the various types of exit, and about just generally changing your type of entity. And then we'll transition to that other topic on intrafamily transactions. So going on to slide 9. So Code Section 1202 exclusion, and as you can see, this is referenced in 2Q7K of my materials. So we're going to talk about the amount of the exclusion. We're going to talk about the stock issuance requirements, which businesses qualify, and how this affects the business structure. And of course, you know that the fourth item is the one that I'm always interested in the bottom line. But you got to know the basics before we get there, so let's go on to slide 10. So the amount of the exclusion, an individual can exclude from the sale of qualifying stock $10 million, or if greater, 10 times the adjusted basis of the stock sold during the year. Now that $10 million is a cumulative amount for that particular company. So if you so each C Corp that you own, you would separately test the greater of $10 million or 10 times the basis of the stock that was sold during the year. So let's go on to slide 11. This stock has to be original issue stock. It has to be issued to the seller, and we'll talk about an exception to that in a moment, and held for 5 or more years. So purchase stock does not count. So let's suppose that that Irene is selling me stock in her company. Irene originally got issued that stock, so she may get the exclusion when she sells it to me. But now that I've got it in my hands, the stock wasn't originally issued to me, it was originally issued to Irene. So that stock doesn't qualify in my hands. So Irene can get the exclusion, but I can't, because it wasn't issued to me, it was issued to her. So the other thing you have to be careful with some of your timing is that redemptions that are 2 years before or after the issuance might be stepped together. So let's say, for example, that Irene wanted to sell her stock to me, and I said, hey, Irene, that's not going to qualify as 1202 stock in my hands. I won't be able to get that exclusion later. So instead, how about the corporation redeems you and turns around and issues stock to me? See? So I'm going to pay the corporation for the stock, and then it's going to use that money to buy you out. So then, from your perspective, Irene, and my perspective, I bought you out. And from the corporation's perspective, it hasn't had to come out with any money. Really, I gave it the money, and it turned around and bought you out. So how about that? That'll give me 1202 stock, right? Well, no, there's an anti-abuse rule. So you're not allowed to do that. Now, let's suppose that Sarah owned the company, and I'm working for the company. And Sarah said, Steve, you're really valued. One day I want you to later take over the company. I'm going to give you some of my stock in the company. And that way you'll be incentivized as an owner, and you'll be ready to buy me out down the road. Well, if Sarah gave that stock to me, Code Section 83, the regulations are very clear that that's considered to be Sarah contributing the stock to the corporation and the corporation turning around and issuing it to me. So this is actually a favorable step transaction. So even though Sarah gave the stock to me, is deemed issued by the corporation to me. And by the way, when the corporation issues that stock to me, I have compensation income because I'm being paid for my services. Much as Sarah might like me, she's not paying me out of the goodnesses of her heart. She's giving me that stock because she wants to incentivize me to work, and then that's going to increase the value of her remaining stock. That's why she's giving me the stock. So I am going to get compensation income for that, but I also get it treated to be originally issued. And if I sell my stock later on, then I'm actually going to be able to count that as original issue stock. So let's go on to slide 12. I mentioned there was an exception to original issue requirement. And of course, I already just mentioned you received as compensation. I'm sorry, this is a different one. So, okay, I received as compensation and I'm retiring or otherwise terminating service. That's what has to happen. The other issue is that it can be passed by death, by gift, or by a trust distribution, or it was purchased or it was purchased within 3 years and 9 months from the day of the decedent's death. So how does that work? So Chuck leaves a bequest of stock to me. So now I'm able to count that as originally issued to me. Another example. Suppose that Tom gave me a gift of stock. I can count that as originally issued. And in fact, I get to add Tom's holding period. So get this. Tom has his $10 million limitation. And Tom wants to sell a stock for $10 million, but actually there's $11 million worth of stock. And suppose that Tom were my dad. So Tom says, you know what, son, I'm going to give you $1 million of stock here. In fact, I've got the sale. I'm not selling the company yet, but I got a sale that's going to happen soon. I'm going to put the company out for market. It hasn't been sold yet, but I plan to sell it. I'll probably get $11 million for my stock. I'm going to give you $1 million of the stock right now, and that way you get the benefit because I love you, but also you're going to get that $1 million income tax free because you can exclude up to $10 million of 1202 stock. And I'm like, yeah, Dad, thanks for that gift. I could really use that $1 million. Maybe I could start my own business with it. But I also get to count the time that Dad held the stock. So, Dad held that stock, for 6 years before he gave it to me. Well, I might have held it for just 1 month, but between the time he gives it to me and the time he sells the company. But I get to tack on his 6 year holding period, so I get to count as if I've held it for at least that 5 year period. And then, of course, so trust distribution. So you may have a trust that owns qualifying stock, and maybe that stock is going to, maybe the company's going to be sold in a few months. So the trust distributes it to beneficiaries A, B, and C. So each of A, B, and C will use the trust holding period, and A will have a $10 million exclusion, B will have a $10 million exclusion, and C will have a $10 million exclusion. Okay, and then you can see the final exception, bought due to divorce, disability, or mental incompetency. All right, so going on to slide 13. So again, I just kind of discussed this, multiplying the $10 million exclusion by gifting. So if there's insufficient lifetime gift tax exemption, so let's suppose that Dad has $30 million in stock and would like to have that entire amount excluded, and didn't really have much basis in it. So son could give $10 million of stock. I mean, Dad could give $10 million of stock to son and $10 million of stock to daughter. Let's suppose that Dad is a widower, so he can't split gifts. So the only problem is that if Dad gave a $20 million taxable gift, and the estate and gift tax exemption is now $11.4 million, Dad will have to pay gift tax. So instead, what Dad might do is give $10 million of stock to an incomplete gift non-grantor trust for the benefit of son, and $10 million of stock to an incomplete gift non-grantor trust for the benefit of daughter. Now, what is an incomplete gift non-grantor trust? So it's a trust where the grantor has enough strings on it that it's not considered to be a completed gift, and the grantor has parted with enough power that it's not considered to be a grantor trust where it's going to be taxed to the grantor. Now, this, to me, these two things are relatively inconsistent, because normally if you keep control over it to avoid a gift, then the grantor trust rules are going to kick in. But there is a way where there have been a bunch of private letter rulings issued where you have a distribution committee and the grantor has a veto power such that it's an incomplete gift, but the distribution committee is considered to be adverse to the grantor, so that it makes it be a non-grantor trust, because things have to be done with the consent of this non-adverse party. With this adverse party. Now, it kind of boggles the mind how they are able to do this, but the bottom line is that there are private letter rulings out there, so you might want to go and look it up. So there's an abbreviation that people use for it: incomplete non-grantor, ING. Incomplete non-grantor, ING, ING. And so if it's in Nevada, they call it a NING. If it's in Delaware, they call it a DING. And my own version, if it's in Delaware and there is some good spendthrift clauses in there, then it's a DING with this also a bankruptcy avoidance trust. So DINGBAT, a dingbat. So you can do other states too. If somebody who's not a Missouri resident, they can set up one in Missouri. So that could be a Ming. And if it's a perpetual trust, that could be a dynasty trust. So then that could be a Ming dynasty trust. So you could put in some 13th century Chinese artifacts in there. So anyway, so you can consider doing those too. If you are doing multiple trusts, there are some multiple trust rules under Code Section 643F, which are very poorly written, that have a lot of ambiguity in them. I would commend you to read ACTEX comments. There were proposed regulations with the Code Section 199A. There were proposed regulations that came out last August, with a comment period that closed in October, and then final regulations were issued in January, just about a week or so ago. What they did, those proposed regs for 199 Cap A also had multiple trust rule proposed regulations in 643F. And the proposed regulations were way overreaching, and they were a big mess. In fact, in 643F, that little F there, that can describe what I think about those. That F can describe what I think about those proposed regulations. But part of the proposed regulations was what I view as government overreach. But another part of them was because the legislative history to 643F was so poorly written, and so there's a lot of ambiguities in it. And if you look at ACTEX comments on 1998A and the 643F multiple trust rules, you will see that there were a bunch of problems to it. And so I commend you to go look at those ACTEC comments, and so you can kind of understand what some of the issues are. Again, some of the issues were with the proposed regs, but some of them are inherent ambiguity in 643F itself. All right, on to slide 14. So which businesses qualify? So the business has to have gross assets of not more than $50 million immediately after you issue the stock. At all times after issuance, at least 80% of the value of the corporation's assets have to be used in one or more qualified trades or businesses. Investments assets are okay if they're used in the qualifying business within 2 years. Slide 15, here's a list of evil businesses, and most of this made its way into the 199A as an evil business. Only engineers and architects were carved out in 199A because they're doing God's work, and the rest of us are evil. Slide 16, here are some more evil businesses for purposes of 1202. So if you're in any of these businesses in slide 15 or 16, you're not going to get the 1202 deduction. Slide 17, you also cannot have more than 10% of the total value of the assets be non-business assets, and they count that as real estate. Now, you shouldn't be having real estate inside of your business anyway if it's a C Corp. So you should keep real estate outside of the C Corp anyway, so just forget it. Keep it out. Go on to slide 18. The C Corp cannot be a former S Corp, so you can't revoke your S election and then become a C Corp, and then you can qualify for the exclusion. However, an S Corp can own Code Section 1202 stock. So the S Corp could transfer all of its assets to a new C Corp and qualify. So what happens is the S Corp transfers its assets to the C Corp. Now it has C Corp stock, and then if the S Corp later sells that C Corp stock, then that gain on the sale of the stock will be excluded, potentially subject to all these limitations we talked about before. Be careful, although corporate formation is normally tax-free, if when you transfer all these assets to the new C Corp, there's also lots of liabilities. Liabilities in excess of basis could trigger income taxation. So beware of comparing assets to liabilities. Now, there is a shortcut way to form the C Corp without having to do a bill of sale and transfer all your assets. That's called an F reorganization. I'm going to be walking you through that later on in this talk. The problem is that when you do this reorganization, the C Corp would keep the original tax ID that it had when it was an S corporation. So now the IRS records are going to say that this is a C corporation that used to be an S corporation. Now the regulations under the corporate formation would say it's treated as a new corporation. But the fact that the IRS's records were showed as a former S corp, that might lead the IRS to want to say, well, you're a former S corp, so you don't get 1202 treatment. So I definitely don't recommend doing that corporate reorganization because of that tax ID issue. Better off transferring your assets through a bill of sale. If need be, you could transfer all the assets to a single-member LLC over the course of the year. Take your time, get them into the single-member LLC. Now you have all your assets in the single-member LLC, and then boom, you just assign your single-member LLC to a new C Corp, or you check the box to count your LLC as a C Corp. then it'll all be done. So there is a way to transition it through the transfer of assets into the single member LLC without disrupting your business, and do the transfer in the due course without messing up your tax returns or anything, and then have it all done at once. Okay, slide 19. So business structure. If you have a wholly owned subsidiary, actually just a majority owned subsidiary, you can count that as a business asset. So you can have a C Corp that has a bunch of C Corp subsidiaries, and you get to look through those C Corp subsidiaries and count their business assets as if they were your own business assets. So that's slide 19. Slide 20. But again, what happens if you have a 51% owned subsidiary and then it turns into a 49% owned subsidiary? Well, now it no longer qualifies as a subsidiary, and that's just treated as if you own stock. Well, stock is not a business asset, so then boom, all of a sudden you've got a non-business asset, and you may blow your 1202 qualification because you have more than 10% of the value of your assets in the subsidiaries that don't qualify. Also, partnership interests are not qualified by subsidiary exception. So if you have your C Corp and you want to do business in a partnership with somebody else, then that partnership interest that you have that is not protected by the subsidiary exception. Now, would you be able to attribute the partnership's business activities to the parent C Corp under some kind of aggregate theory? I don't know. Maybe you could. But I definitely don't feel safe in doing that. So if you're stuck with the situation, there's some arguments I would make, and my materials mention those arguments you might make. But I just wouldn't count on it. Now, if you have a single member LLC, presumably that would be disregarded. But again, I don't know that I want to count on that. You could have a wholly owned subsidiary and file a consolidated corporate return and get more or less very similar benefits to having the disregard entity single member LLC. So before doing a single member LLC subsidiary, I would first investigate doing a wholly owned subsidiary and filing a consolidated return. I would look at that first before considering doing the single member LLC, and go to your corporate income tax people. I'm not one of them. Slide 21, brother-sister corporations. If you have more than one trade or business, put them each in a separate C Corp, and then they'll each get the separate $10 million limitation. But that's not always the best business structure, and slide 21, I mentioned some disadvantages to doing that, but I'm going to move on because I'm running behind on time. Slide 22, you might consider starting as a partnership and then convert to a C Corp. That allows owners to deduct startup losses. It allows you not having to worry about having the assets qualify during your startup phase. It allows tax preferred exits in case you need to make changes in your equity structure while the business takes its shape. And it allows, during those 5 years, if you need to buy somebody out, there's maybe tax advantage ways to do that. It allows a higher exclusion if the assets exceed $1 million at the time of conversion as well. So if you had $5 million of assets when you convert, then you could have a $50 million exclusion under that 10 times rule. So there's some advantages to that. Slide 23, there's the disadvantages. It delays the exit because the 5-year holding period doesn't start until the entity becomes a C Corp. So if you start as a C Corp, after 5 years you can sell and get the exclusion. Whereas if you start as a partnership and convert after 3 years, well, then you have to wait another 5 years before you can sell it, so you have to have waited 8 years instead of 5. The other thing is it prevents the exclusion on gain on sale attributable to the pre-conversion gain, and I'm going to go over that in a moment. I'm going next to the slide. Next slide is the code word exclusion. So write down exclusion for your CLE records. Okay, going on to slide 24. Oh, you know what? Actually, that is all of 1202. So let me go back and talk about this preventing exclusion on the gain of pre-sale growth or of sale attributable to pre-conversion growth. Let's suppose that when you convert from a partnership to C Corp, so again, we're back on slide 23. So on slide 23, the very last bullet point, that if you were a partnership and you convert to C Corp, and let's suppose that the assets had a basis of $1 million and a value of $5 million. You get to count the fair market value as the basis. It's a weird rule. It's in there. You get for purposes of that 10 times number. You don't get basis for that $5 million for normal income tax purposes. You still have a basis of $1 million. But for purposes of computing the 1202 exclusion, you get a 10 times number. So if it's $5 million fair market value on the date of conversion, then you can exclude up to $50 million of gain. The only problem with that is that you had a $4 million built-in gain when you did that conversion. That $4 million of gain is not qualifying gain because we have to pretend that the basis was $5 million. You cannot get an exclusion on that first $4 million of gain when you sell the stock. So the advantage of doing the later conversion is you can multiply your exclusion, but the disadvantage is that you don't get the exclusion on that built-in gain at the time of conversion. All right, now on to slide 24. Other ideas. If you get a capital gain and you invest your assets within 180 days in an opportunity zone, then you are allowed to have a deferral or a partial exclusion of your capital gain tax. Now my materials 2G7 goes through the statute for that. There are some proposed regulations out that talk about what are the rules on an opportunity zone, and I have not gone through those in depth. I just want to let you know that that there is an exclusion, and you don't have to be 1202 stock. You get this exclusion no matter what, as long as you invest yours, or you get the deferral or partial exclusion, regardless of what kind of stock you had. Also, I mentioned an advantage of a partnership is you can deduct losses, startup losses, and they're ordinary losses. Well, if you have C Corp and you abandon your C Corp stock, or you might be able to get an ordinary loss for it. And again, that's mentioned in 2G8 what you have to do to qualify for that. And also, some startup stock can be called 1244 stock, and you can get an exclusion for an ordinary loss on the sale of that stock, but it's limited in amount. So I'm just saying that if you want to try to get an ordinary loss on the sale of C Corp stock, and you're kind of like, well, I didn't have a partnership, so I couldn't take an ordinary loss. When I incur the loss, maybe I can take the ordinary loss when I get rid of it. So those second and third bullet points are ways to look at to see whether you might be able to get an ordinary loss on it. Another thing in the fourth bullet point there is this preceded the idea of the opportunity zones. A specialized small business investment company. My materials kind of refer to that and give you a helpful link. So again, that's you can sell marketable securities and get that kind of exclusion too, or a deferral. All right, going on to slide 25. So there's people say get code section 1202 stock, and then you can exclude the gain on the sale, and wow, that's a huge tax benefit, and that makes us really like getting C Corp stock because we can exclude gain on the sale. Well, that thinking is one-dimensional. The bottom line is that when somebody sells a business, the buyer wants to buy the assets. And they want to buy the assets. There's two reasons they want to buy the assets. One of them is they want to buy the assets without getting the potential contingent liabilities. So they would rather buy your factory and equipment than inherit your product's liability exposure. So they would rather just buy those goods. Now, sometimes it's not really all that possible to transfer the assets because the business is too complicated, or maybe you have some non-assignable assets or something like that. And in that case, what they will do is they may buy the stock, but they want to get the tax benefits from the asset's current value. So, like if you had real estate that was worth $10 million and it had a basis of $1 million because you depreciated it, they want to be able to depreciate that full $10 million. So they want to buy that, or there's a tax election that can be made. If you buy stock instead of assets, buyers will typically require a special election to treat the sale as if it were an asset sale followed by a corporate liquidation. So the buyers buy the stock, but they get to pretend that they bought the assets and that the corporation was liquidated, and then they basically are inheriting this corporation with assets that have basis equal to the value. So that way, with that $10 million building with a basis of $1 million, they get to have a $10 million basis in it. So even though they bought the stock and not the asset, this election will treat it as an asset sale. They'll get the stock and get the $10 million basis in that real estate. So the buyer will often insist on that because, heck, they could have bought the assets elsewhere without having this built-in gain tax. They want to get the full depreciation. So buyers often insist on that. And if they don't, if you don't do that election, the buyer will often reduce their price to say, hey, I'm paying for $10 million a building. I'm not getting depreciation deductions I should be getting. So I'm going to pay you a lower price because I'm not getting those deductions. So the Code Section 1202 exclusion doesn't protect you against this. What happens is when you sell your C Corp stock and then the buyer insists on this election, then there will have been a deemed sale of the stock, and then there's going to be income tax to be paid on that. And that's going to ultimately reduce what you get. So this deemed sale this gain on the sale of the assets is going to come back to bite you. So the 1202, it'll help you avoid tax on the sale of the stock, but it won't help you avoid the tax on the asset sale, or at least you'll get a reduced purchase price because of it. So how does that compare with S corporation? Let's go to slide 26. Now, when you have an S corporation and you make this special election, so what happens is the seller is going to get a K1 for this gain, and we'll be able to add that gain to the seller's basis. So, for example, let's suppose that we had this S Corp that has $10 million of real estate in it, and this $10 million of real estate, and that real estate, and the basis in the real estate was 0, and also the basis in the stock was 0. So what happens is when there's a deemed sale of that real estate, then there'll be a $10 million capital gain on the deemed sale of that real estate, and that $10 million of capital gain will come through on the K1 to the shareholder, and they'll have a $10 million gain to report. Okay, but they will get $10 million of basis for that gain that they had to report. The $10 million of basis gets added to their stock. Their K1 income is added to their stock. Now their stock has a $10 million basis. So when they receive the $10 million of sale proceeds, they'll have $10 million sale proceeds and $10 million of basis. They will have 0 gain on the sale. So an S corporation shareholder, if they're able to get this election done, they will only have to pay tax on the gain on the sale of the assets, just like, and it's really not just like, but I'm analogizing it to the sale of the assets when you have the C Corp environment. Either way, there's a tax on the sale of the assets, but not a tax on the sale of the stock. So the S Corp has the equivalent of an exclusion on the gain of the sale of the stock because of this. Now, it's not really entirely apples to apples, because that S Corp, for example, may have assets that would generate ordinary income on the sale. So they may generate ordinary income at a higher tax rate, whereas when the C Corp has income tax, it's at a lower rate. So the asset sale, the deemed asset sale, may have a higher tax rate than the C Corp, but the bottom line is, in either event, there's not really going to be a capital gain tax on the sale of the stock. So the C Corp, the C Corp may have an advantage here, but it's not quite as big an advantage as you would think with the idea of the 1202 exclusion. Okay, slide 27. This slightly increased tax on the S Corp sale of assets may be worth the benefits of an S Corp. So remember that a C corporation that distributes income is going to be taxed at a higher rate, because you have the C Corp income tax and the shareholders have a dividend tax. So only if a C Corp reinvests the vast majority of its income would being a C Corp be advantageous over being a pass-through entity. And you'll see in my slides, there's a link to my January 30th, 2018 webinar, and I go through the effective tax rates of a C corporation that distributes none, half, or all of its earnings. And I compare that to a pass-through entity. And I also have a link to a condensed version of it. The January 30th, I would say, is more thorough. That really is about 25 to 30 minutes when I'm going through those tax rates. The condensed version is only 17 minutes long. So you can look at either one. Also, GRATs and sales to irrevocable grantor trust, those don't work well with C Corps. And my January 30th webinar also goes into that detail. Furthermore, if you have an S Corp and there's a basis step up on death, then who cares about the exclusion? You're going to get a new basis in it. Okay, so the bottom line is I still favor pass-throughs, and a C corporation, again, Professor Sam Donaldson really did the proper analogy to it. A C corporation is like a roach motel. Congress is luring you into this now, but when you exit from it, it's going to cost you a lot. So you can get in, but you cannot leave. And I'm very concerned about, we call things a permanent change, permanent tax change. But don't forget, Tax Reform Act of 1986, that was a permanent tax law. And that gave individuals the top bracket of 28%. And over the years, lots of changes were made. And in 2017, the top effective individual rate was over 43% for those who had to pay net investment income tax. So it crept up from 28% to over 43%, a more than 50% increase in tax rates over time without anything that they called major tax reform. So if that doesn't make you think that the Congress is creepy, I don't know what does. So I don't trust any rates to be staying the same for any period of time, and so I want to be nimble. I want to be with a pass-through. 99% of the time, I'm not going to be a C Corp. I'm going to channel Nancy Reagan and just say no. Okay, let's go to slide 28 and just, again, compare about the types of entities for the seller finance sale of goodwill. So the idea here is that goodwill has zero basis, and certainly if you have self-created goodwill, I mean, you started your C Corp from scratch. It has zero basis in the stock. It built up all the goodwills over the years. That didn't add any basis to your stock. So I'm going to go through and talk about C corporation, triple taxation, S corporation, double taxation, partnership, single taxation, etc. So slide 29, if you have a C corporation, suppose there's a sales stock for $100. That's your third bubble there, or score box. $100 sales stock. The seller is going to have to pay capital gain tax. And I have here a hypothetical, 20% regular capital gain tax, 3.8% net investment income tax, and then a hypothetical state income tax. So $29 is state income tax, $71 net after tax for the seller. But how does the buyer get the $100? The corporation does a dividend. $140 dividend, the shareholder pays $40 of tax on it, has $100 left. But how does the corporation earn the money to get that dividend? By business earnings. So $189 of business earnings, and then I impose a state income tax, federal and state income tax of $49. I had 21% federal plus a 5% state. I just assumed the moderate state income tax. So $189 of earnings, $49 of tax inside the corporation. Corporation has a $140 dividend. The new shareholder pays $40 of dividend tax on that, has $100 left, pays the seller $100. The seller pays $29 of capital gain tax, has $71 left. Very inefficient. $189 of earnings, they get the $71 left net after tax. Slide 30, if I have a C corporation redemption, the dynamics work a little bit differently. The buyer doesn't have to get the money out. The C Corp itself buys the stock. So it takes $135 of business earnings to get $100 net after income tax, which the corporation then pays the seller, and the seller pays $29 of capital gain tax and has $71. So again, $135 of earnings to get $71, not very tax efficient. Why wouldn't somebody just always do redemption instead of a cross purchase? Because the redemption has a lower tax rate. Well, if you have shareholders A, B, and C, and A wants to buy out C so that A has 2/3 control, that has to be done by a cross purchase. If the corporation redeemed out C, then both A and B are going to be essentially paying for that purchase, and they'll be 50-50 owners, and you won't have A being the 2/3 owner. So there's a redemption just doesn't always work. All right, slide 31. Let's suppose we had the 1202 exclusion, and you had a cross purchase. We still have 2 layers of tax. In this example, the business earns $135, pays $35 of tax, and there's $100 left. Then the corporation distributes that $100 to the buyer. The buyer pays $29 of dividend tax on that and has $71 left. So the seller is going to get the $71. He's going to get the full price and not have to pay capital gain tax on it. But we've had 2 layers of tax to get the money out to the buyer so they could pay the seller. So there's still a double tax going on here. And going in slide 32, let's talk about an S Corp. People think of S Corps as being pass-throughs, only 1 layer of tax, but that's not quite true. The seller is going to pay capital gain tax of $29, just like they did before, and the owner of the S Corporation, the buyer, is going to have to pay tax on the business earnings. So in this example here, the buyer is going to be paying tax on the business earnings of $53 to $85, depending on the tax rates. And again, my January 31st, 2018 webinar goes over this, and so you'll be able to see better how the 45.8% rate contrasts with the 34.6. It goes over that range of rates. So there's going to be a double tax, 53 to 85 paid by the owner and by the buyer, and $29 paid by the seller. Slide 33. There is a way in a partnership, particularly the main way that this helps is if you don't have a capital-intensive business. If it's a service-oriented business, particularly, it's very straightforward. If it's a capital business, there's some ifs, ands, and buts in this. But in a service business, particularly, you can structure your buyout so that the selling partner will pay the tax on the operations and doesn't pay capital gain tax. Now you have to pay a higher purchase price to the seller because they're paying ordinary income tax instead of capital gain tax. But if you take these numbers here on slide 33, the 109 to 131, then I'm going to take the 131 for my example. I'm going to take the worst case scenario on the partnership. Suppose you had a 45.8% rate. So 131 it takes to buy out the seller. $131 of partnership earnings to buy out the seller and have the seller receive $71. Let's plug that $131 from the partnership scenario in to slide 34. On the left-hand side, you see that $131. Now, in this example, the partnership is going to use the same earnings as the S Corp. So if we went back to the S Corp slide, back on slide 32, we will see on slide 32, one more back, that the S Corp required $185 to buy out the seller, $185 of earnings. So I'm going to plug that in on slide 34. So let's go on to slide 34 and to the right on slide 34. So then on slide 34, one more, I'm plugging that $185 from the S Corp scenario in at the top. And on the left-hand side, I have the 131 from the partnership example. So in the partnership example, we have the same as we had on slide 33, $71 going to the seller, $60 going to Uncle Sam. But if we had a partnership and it was able to take that $185 from the S Corp, there's another $54 left over on the right. $185 at the top minus $131 on the left equals $54 on the right. So there's $54 of earnings from the S Corp example that are left over if you had a buyout through the partnership. Now you're going to have to pay tax on that $54, but there's going to be $29 left over if you were doing the buyout with a partnership instead of an S Corp. So a partnership actually gets you 29% extra money available that the buyer and seller could use to split it. Usually the buyer gets the benefit of it, but there is extra money left over. Let's go to slide 35. If you took, and I'm not going to flip the slides on this one, if you took the $135 from the sale of with the exclusion, if you took the $135 of income that was needed to generate that $71 going net after tax to the buyer, to the seller, and plug that into the partnership scenario, you will see that that is still more earnings required to buy you out when you have the 1202 exclusion. And you can see there's money left over on the right-hand side. So I wish I had more time to go through this. I was over-ambitious on today. And but the January 28th, January 31st, 2018 webinar goes through this. Okay, let's go on to slide 36. This is a structure which I think would be good to have for a lot of people. You might have a limited partnership with individuals and a corporation being the general partner. If you started off as a C Corp, then that would be a C Corp. If you started off as a partnership or an S Corp, then that would wind up being an S Corp. And the idea here is that limited partners get an exclusion from self-employment tax for their distributed share of income. So basically in this scenario, nobody pays self-employment tax on the distributive share of income, but you can get potentially the large majority of your assets inside a partnership structure and get the benefits of the partnership buyouts. All right, slide 37 are the reasons I like that idea. I have them more in my materials, so I commend those to your reading. It's in part 2E where I go through it. Slide 38, I kind of go through some slides here about ways to move into this structure. So slide 38, corporation could form an LLC. Then if you go on, and slide 39 does a narrative on that, and 40 does some more narrative, and slide 41, there's another way to form that LLC, is you can use an F reorganization, which is talked about on slide 41 and 42, and 43 and 44. I don't have time to go through that right now. I'd be very happy to go through those details with you. The bottom line, though, in slide 45 is, so on slide 45, we would have the C corporation would be a 10% general partner and have a capital account with a preferred return. And then the individuals would be 90% limited partners. And normally what happens with these deals is that most of the goodwill is personal, and so you're allowed, so you can basically move the value of the goodwill over to the partnership as a contribution to capital. It's not part of the inherent part of the business because the business they didn't have a non-compete with it. Okay, I'm sorry I went too fast on this, and I'm happy to. If you want, you can write in your evaluations. Please go through the migration again, and I'll do it at some point later on this year if I have enough requests. Again, I think I did go over that in my January 31st webinar. Okay, let's go to slide 46 and talk about migrating a business. And we're going to talk about this Dynamo Holdings case. I haven't really heard anybody talk about it yet. But there were really two basic issues that interested me from this. There was an intrafamily sale of stock, and the taxpayers lost that. And you can see there's a link to my discussion, my detailed discussion on it. And there were some intrafamily loans, and the taxpayers won. And I'll go through that as well. And by the way, I do encourage people to submit questions into the chat box. All right, slide 47. Let's talk about the intrafamily sales. So back in 2009, there was a case called Cox Enterprises. And there was this corporation that had, I don't remember if it was a radio or TV station, some kind of broadcasting business in the San Francisco area, and it didn't have a positive net cash flow. They wanted to get rid of this. It wasn't really a good fit with their business plan. Oh, there we go. It was a television station. I have it right in front of me. So what they did, they tried to shop around this television station, and they couldn't find any buyers for a fair price. So what they did is they contributed the television the C Corporation contributed the television station to a partnership. It was actually an LLC, and it turned out that the partnership interest they got back was worth a lot less than the assets it contributed, to the tune of $60 million. And the IRS is like, whoa, well, this must be a dividend to the other partners in the partnership. So let's tax you on that. And especially because the partners in the partnership were related parties. And in this case, what happened is there were these trusts that owned about 98% of the corporation's stock. And they had shareholders of a couple of percent who were like unrelated people. And what happened is, so basically the primary beneficiaries of those trusts would get the benefit of any corporate distributions. And what happened is that the remainderment of the trust, so, if there's a trust in me for life to Irene on my death, okay, I'm the current beneficiary, and Irene is a remainderment because she gets that remainder when I die. So in this case, what happened is the remaindermen were the partners in the partnership. So it kind of looked like they were kind of making a gift from the current beneficiaries of the trust who owned who had current benefits from the corporate stock to the remaindermen who got those partnership interests. So that's what it looked like. So here's the deal. Go on to slide 48. The corporation contributed assets worth $300 million. It became the managing general partner. It received a majority partnership interest, which entitled it to 55% of the partnership's profits, up to a certain base, and 75% beyond the base. So again, that's 55 to 75% of the profits it was getting back. Go to slide 49. The other partners contribute assets worth $62 million. But so the bottom line math is that the corporation contributed almost 83% of the value. Contributed $300 million when there was a total of 362 in it. And so it contributed 83% of the value, but received profits of 55 to 75%. So clearly it was getting less profits back than what it put in. Slide 50. The other partners contribute assets worth $62 million and receive the balance of the rights of distributions. That's just a repeat. Okay. I'll have to take that out next time I do this presentation. All right. Slide 51. The tax court held there was no gift here. The partnership's formation had non-tax business reasons. Some independent consultants had told the corporation to sell that, and the partnership formation allowed the corporation to retain the working capital previously needed for the TV station. So it redeployed its capital. It took its working capital that it had to use for the TV station and used it otherwise in the business, and the remainder men provided that $62 million of working capital. Slide 52. So the other partners had to make cash contributions that were intended, so it's not a gift. I mean, the fair market value of what those remainder men got back was equal to the $62 million they put in, and they couched everything in good business language. Slide 53. Everything was done in an arm's length way, and so the tax court said, arm's length business deal, you win. Slide 54. It relied on Byram, which we know that the courts haven't really been using in family limited partnership deals. But you notice, I mean, Cox was a 2009 case. Strange was a 2001 case. Baumgard was sometime between. So the court had already basically emasculated Byram as it comes to partnership interests. But the court in Cox, the court kept Byram around for corporate interests. And Cox, 2% of the stock was owned by people who were not members of the controlling family. They were employees, and they were fiduciary duties. Just like Byram had fiduciary duties, Cox had fiduciary duties. Slide 55. The tax court, again, was convinced with it having business purposes. So even though there was an actual reduction in the wealth of the corporate shareholders in the Cox case, it was sufficiently business motivated, and the remainder men didn't actually receive more than they put in, so the remainder men didn't receive a gift. They put in as much as what they got. They didn't receive a gift. So Cox, I said, was legit. Slide 56. Dynamo, not so. Before I get into what happened in the case, I'm going to talk about the law. Cox was there a constructive distribution, and Dynamo, there's a constructive distribution. So in Dynamo, the tax court said, transfer property from one entity to another for less than adequate consideration may be a constructive distribution to an individual who has ownership interests in both entities. So I own Corporation A, and I own Corporation B. If Corporation A will do a bargain sale to Corporation B, then that's a benefit to me. I benefit as the owner of bargain B when there's a bargain sale. So that's really a dividend to me from Corporation A to me, followed by me making a contribution to Corporation B. After all, I use my ownership in A to get a benefit to B. So that's a constructive distribution. Now, just because the bargain sale, just because it looks like a bargain sale doesn't mean that it was done for purposes of giving me a dividend. It could be the Corporation A didn't want that property, just like Cox. Cox, they didn't want that property. They needed to get rid of it. They did a transfer away. They got back less than what they put in, but you know what? They had to do it for business reasons. You know, the devil made me do it. I had business reasons to do it, and so even though I got back less than what I gave up, it wasn't a constructive dividend. I had a business reason for it. So slide 57, there's a two-pronged test for constructive distribution, an objective test. Did you cause the funds to leave control of the transferor, and you as a stockholder exercise control over those funds? And did you have your own reason for it rather than the corp? So did I have a reason for it that was my own reason? In my example of A doing the bargain sale to B, was it for A's business purpose, or was it because I, as a shareholder of B, wanted to do it? So it was for my benefit that we did it to B because I wanted to have a better investment in B. That's bad. So slide 58. Those are the two prongs. And slide 59, those are the two ways for the objective prong. Slide 59 is a subjective prong. 60 goes over the subjective prong a little bit more. And slide 61, there was a single bargain sale. Slide in Dynamo, there were 5 bargain sales that exceeded $200 million. And this furthered the principal owner's estate planning. And so that was the big difference, is repeated, you do it once, maybe you'll get a pass on the tax court. But 5 times, that was a little bit much for the tax court. So the tax court said that there was a bargain sale, and so there was a constructive distribution. Slide 62. However, there were intrafamily loans, and those intrafamily loans, the taxpayers won on that. So first of all, I do, in my materials, in my newsletter where I go over this, I have cross-references to various provisions in my materials that talk about intrafamily loans and when you might respect them in various contexts. I'm going to go through now the law here, but before I do that, I want to commend to you in terms of intrafamily loans, the best paper that totally focuses on that was written by Steve Akers, Akers, and Phil Hayes of Bessemer Trust, Bessemer. And they have a great paper on that. So I'd recommend going and looking them up and getting the paper from them. To be treated as loans, advances required an unconditional obligation on part of the transferee to repay the money, and an unconditional intent on part of the transfer to secure repayment. Slide 63. Special scrutiny goes to intrafamily transfers, particularly when they have the same corporate family or shared ownership. Transfers between family members are presumed to be gifts. And the presumption can be rebutted by an affirmative showing that there existed a real expectation of repayment and an intent to enforce a collection. So here you are. Family transfers between family members. One transfers money to the other. The other one promises to pay it back. Is that a real loan or not? It's presumed to be a gift. What do you have to do to prove that it was actually a loan and not a gift? So, the real expectation of repayment and intent to enforce a collection. Slide 64. The court said it's useful to compare the transactions that are going on here to arm's length transactions and normal business practices. However, related parties are often kind of sloppy, and particularly when we have intrafamily thing. If A is loaning to B, and they're all under the same control, and we know that B is going to repay A because they've always done it, well, then maybe we'll give them a pass if they don't do everything exactly right. And the court said that security and other creditor protections are less important in the related party context, because the lender can actually control repayment and make sure he gets repaid. Slide 65, evaluate all the pertinent facts. And you can see some facts and circumstances in slide 65 and 66. On slide 67, there were some defects in documentation here. They didn't always have a contemporaneous promissory note. They did it kind of after the fact. No collateral, no demand by the lender, no fixed maturity date. So those were all bad facts. In slide 68, the borrower and the lenders maintained records that reflected advances as debt on their general ledgers. There were some promissory notes. The management of the debtor and lender were the same, so they knew each other's financial information. They didn't have to get covenants on it. They knew about the information. Slide 69, notes can just be paper. And sometimes courts will disregard the notes, and sometimes they won't. Here there was something to back up the notes, not just legalistic stuff, but real on-the-ground facts. Consistent reporting of interest, income, and expense. The borrower did have the ability to pay objectively, did in fact pay, and also repaid third party to these lenders. So the conclusion on slide 70, they had a legit debtor-creditor relationship. Unconditional obligation to repay, unconditional intent to enforce, no constructive distribution for this, and so interest income and interest expense. So whenever I do intrafamily loans, I do want to do contemporaneous loans, and the vast majority of the time insist that my client provide for repayment of at least interest every year. And if they don't do that, then I am going to ask them, why aren't you going to pay the interest? What's the business purpose, the business exigencies? How do I know that interest is going to be paid in year 2, in year 3, in year 4, in year 5, in year 6 if you don't pay it in year 1? Why aren't you going to be able to pay it in year 1? And if they can provide a compelling reason why the money will be there in years 2, 3, 4, and 5, that's not just wishful thinking, then maybe I'll not make them pay it in year 1, and I'll in fact put on the loan that the first payment is due in year 2. But that is rare for me. So I do recommend full documentation, but if you're caught, this case has 2 basic principles. Number 1, the court said if you paper it over, that's not enough. You need to prove it through objective facts. This case provides objective facts that you should be going through to try to back up the legitimacy of your loans. And number 2, if your clients do mess up and they didn't document it, not all is lost. You still can face an uphill battle and possibly win. So the next slide is the end. Slide 70. This is loan is the key word. So write down loan as a third word from the CLE. Slide 71. Upcoming things. On February 12th, there's a webinar on the fiduciary income tax. So we're doing a refresher and an update. We will also cover a little bit about the fact that Uniform Principal Income Act had a rewrite, and it's now called the Uniform Fiduciary Income and Principal Act, or UFIPA. So we're going to talk about fiduciary income taxes. We're going to talk about the current regulatory environment for fiduciary income tax, but we'll also talk a little bit about UFIPA and how there's more flexibility in fiduciary income tax when the states adopt UFIPA. And we'll also talk about you could draft that into your own documents. I know Code Section 179A, capital A, I wanted to talk about it here. I devoted my October webinar to that, to the proposed regs. I wanted to devote this to the final, but they didn't come out soon enough. So I am going to do a webinar on February 20th with ACTEC, and that's definitely the hard and fast thing, and that announcement will come out in the next couple of days. And sometime in March, there should be one with American Bar Association Real Property Trust and Estate Law section. So tentative plans are to do that with Bob Keebler and some government speakers like we did last year. But those are all tentative, so I can't promise that that's going to happen. But it's being worked on right now. April 23rd is my next webinar for my first quarter newsletter. I encourage people to subscribe. Also, heckling just concluded, and I forward. There's an ABA Ripity has a team of reporters that reports on heckling. I forward those reports with some comments to my heckling newsletter list, and if you like those, you can sign up for heckling. So, and if you sign up now, you'll get all the reports from this past year. From just this past January, like last week. From last week, you'll get those reports. And then finally, I have my blog. So sorry I ran over. I hope you found it helpful. I didn't have any questions, so hopefully I was perfectly understood. But you are certainly welcome to contact me at any time. All my contact information is on the cover slide. So you're welcome to contact me to discuss any of this stuff anytime. So I hope you enjoyed this. I hope you got some value, and look forward to talking with you next time. Thank you.